Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into Seatrium Limited, trading on SGX as 5E2. And I have to tell you, this is one of the most compelling stories in Singapore's marine engineering space right now. Multiple analysts are issuing buy ratings with price targets around $2.78, representing a potential 34% upside from current levels. But here's what caught my attention, and why I think this deserves a much deeper analysis than what you'll find in typical market reports. Let me start with the numbers that are making analysts excited. Seatrium just reported a massive net order book of 21.3 billion Singapore dollars as of end March. That's not just impressive, it's transformational for a company that was struggling just a few years ago. This represents 26 active projects with delivery schedules stretching all the way to 2031, providing incredible revenue visibility in an industry known for cyclical volatility. But here's where it gets really interesting for Singapore investors. 7.1 billion of that order book comes specifically from renewable and green energy projects. This isn't just about traditional offshore oil and gas anymore. Seatrium is positioning itself at the heart of the global energy transition, and given Singapore's strategic push to become a green finance hub and regional clean energy center, this timing couldn't be better. The company completed 45 vessel repair and upgrade projects during the quarter, including cutting-edge carbon capture retrofits. They're working on projects for cruise ships, LNG carriers, and offshore vessels. 9 projects worth $387 million are scheduled for delivery this year alone. What excites me most is their memorandum of understanding with BP for a deepwater floating production unit in the Gulf of Mexico. This extends their existing collaboration with the oil giant and demonstrates Seatrium's global reach beyond Asian waters. Now, let's talk about why this matters specifically for Singaporean investors. First, from a CPF and SRS perspective, Seatrium is included in the CPFIS approved list, meaning you can use your CPF ordinary account funds to invest. Given the current CPFOA interest rate of 2.5%, the potential returns here could significantly outpace your guaranteed CPF returns, though obviously with higher risk. Second, Singapore's maritime sector incentives are creating a perfect storm for companies like Seatrium. Under the maritime sector incentive schemes, companies involved in Singapore flagged ships and offshore engineering enjoy substantial tax exemptions. This includes full corporate tax exemption on qualifying shipping income and gains from ship sales. For Seatrium, this translates to better margins and more competitive pricing globally. The broader macroeconomic picture also supports this thesis. Singapore just announced an additional $5 billion for the Future Energy Fund in Budget 2025, specifically targeting clean energy infrastructure. The government expects that by 2035, around 1/3 of Singapore's electricity demand will be met through imports, requiring massive offshore infrastructure investments. Seatrium is perfectly positioned to capture this opportunity. But let's address the elephant in the room. This is still a cyclical industry with significant execution risks. Seatrium's transformation from the old Sembcorp Marine wasn't without challenges. The company went through a major restructuring, and while the current order book looks impressive, project delays and cost overruns remain real risks in offshore engineering. The recent technical analysis from Lim and Tan Securities shows a bullish crossover in the MACD, but the stock has dropped 14% in April alone, suggesting volatility remains high. What gives me confidence is the diversification strategy. Unlike pure-play oil and gas contractors, Seatrium is building expertise across floating offshore wind, LNG infrastructure, and even nuclear-related marine engineering. Singapore recently signed agreements with the US on civil nuclear cooperation, and the government is proactively studying nuclear power development. This could open entirely new revenue streams for Seatrium's specialized engineering capabilities. The floating offshore wind market is particularly exciting. Industry projections show this sector growing from $1.15 billion in 2025 to over $170 billion by 2037. That's a compound annual growth rate of over 50%. Seatrium's experience with floating production platforms gives them a significant advantage in this emerging market. From a valuation perspective, analysts are forecasting earnings growth of 27.7% annually over the next 3 years, with revenue growing at 3.3%. The return on equity is expected to reach 10% by 2027. These numbers suggest the company is not just growing, but becoming more profitable and efficient. However, I do have some concerns that I think the analyst reports aren't fully addressing. The global trade environment remains uncertain, especially with potential U.S. tariff policies affecting Singapore's manufacturing exports. Seatrium's exposure to international markets means currency fluctuations and geopolitical tensions could impact project timelines and profitability. Additionally, the transition to green energy, while promising, requires significant capital investments and new technical capabilities that may strain resources in the short term. The competitive landscape is also intensifying. South Korean and Chinese shipbuilders are aggressively expanding their offshore capabilities, often with substantial government backing. Seatrium needs to maintain its technological edge and cost competitiveness to defend market share. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. Looking ahead, I see several key catalysts that could drive Seatrium's performance. First, the company's partnership with SP Group on solar energy solutions for their shipyards demonstrates operational efficiency improvements. They've installed over 10 megawatts of solar capacity, reducing carbon emissions and energy costs. Second, the expansion into subsea robotics and digital technologies positions them for higher margin services beyond traditional construction. My overall assessment is cautiously optimistic. The $21 billion order book provides substantial downside protection, while the green energy transition offers significant upside potential. For Singapore investors, this represents a way to participate in both our maritime heritage and our sustainable future. The analyst price targets around $2.78 seem reasonable given the fundamentals, though I'd expect continued volatility as the company executes on these major projects. The key risks to monitor include project execution, global economic conditions, and competitive pressures. The opportunities include Singapore's energy transition policies, growing offshore wind markets, and potential nuclear infrastructure development. For CPF investors, this could be a strategic long-term holding, but position sizing should reflect the inherent cyclicality of the marine engineering sector. Seatrium's transformation story is far from over, but the foundation for sustainable growth appears solid. As Singapore continues building its position as a regional energy hub, companies like Seatrium that can bridge traditional marine engineering with next-generation energy infrastructure will likely be the biggest beneficiaries.